All right, let's get started. Our first panel of the day is titled Robo-Advisors and the Evolution of Wealth Management. Our panelists are Andrew Rudd, the CEO of Advisor Software, Chris Osmond, Chief Investment Officer at PCIA Wealth, Mark Ferrari, Research Scientist at Advisor Software, and Sharon Liebowitz, the Director of Innovation and Strategy at S&P Dow Jones Indices. Please welcome our panelists to the stage.
Thank you. I'm Andrew Rudd, and it's a real pleasure to be here. And it's absolutely clear you don't need AI to realize that we have got a larger audience here than in Forum B. So thank you. I may be asked back next year. We've got a bunch of simple questions, and then they progressively get harder until, all the audience is gone, and the panelists have also left. Okay, first up, what are robo-advisors? Why have they gained popularity amongst both individual investors and institutions? Sharon.
Oh, hey. Threw me off on that one. I thought we were just going to do a little intros first, but hey.
Come on, yes, of course.
Absolutely.
Yeah. While you're thinking of the answer, give us a little intro.
Exactly.
Yeah, exactly.
I'm Sharon Liebowitz. It's great to be here today. I always loved building things, so I actually trained as an architect, but I quickly moved from building buildings into building technology. So I built trading systems for the largest investment banks. I founded a Robo-Advisor Maritime focused on nonprofits and other institutions, and currently I design innovative indices for Dow Jones Indices. And I really believe that great design is the source of great products and great platforms.
Great. My name is Chris Osmond. I am the Chief Investment Officer for Prime Capital Investment Advisors. We're an RIA located actually in Overland Park, Kansas, so from the Midwest, coming all the way out to New York. So thank you for having me. We manage about $10 billion, spanning from California down to Florida, really bifurcated on both DC qualified plans as well as retail wealth management. I've been doing this managing investments, I should say, for going on 16 years, CFA, CFP, and really in charge of creating investment strategy for our firm, trying to improve efficiencies, both for our end client and model, and I should say investment creation, portfolio design, but also trying to leverage technology to make our job more efficient.
I'm Mark Ferrari. I'm one of those physicists who moved into the world of finance. Not the first one to talk today, obviously, and I found out this morning not even the first Bell Labs alum to talk this morning. So after I switched to finance, I worked at what used to be Barra, that subsequently got acquired by M.Sc, building risk models and forecasts of transaction costs. Did some fairly straight-ahead quantitative investing at Berkeley's, acquired by BlackRock, and also for AXA. And I've worked for a couple of more oddball startups that applied data science to forecasting movie revenue or housing prices. So it's been an interesting ride, and here to talk about it.
Let me go back to the question, but change the question because you've had time to think about it. Have you built Robo, done any of those things? Any quick little vignette that would give some confidence to the audience?
Yeah, so I think building a robo is certainly right now, as we sit here in 2019, I mean, robos probably started around 2008, 2009, although I think some people would argue that they've been around a lot longer. But I would say that if you looked at the early generation, it was really about, bringing technology to gain efficiencies and using low-cost products such as index products or passive ETFs. Clearly, I come from Dow Jones Indices. We're big on passive ETFs, and that's key for us. And also, I think initially the early robos were all about asset allocation, right? Let's understand who the client is and get the right risk appetite for them and create that appropriate asset allocation. I think now, fast forward a number of years, you're seeing the next evolution where it's really more of an end-to-end platform. You can do automated account opening, handle a lot of the client requests in an automated fashion, and really give a lot back end to the advisors to help support them.
Right.
Chris? I'm
just going to jump in here because I like the history, and I would say that one of the recent evolutions in robo-advice is that it's not only a standalone product, but there are many APIs available. And so with the wide range of financial solutions that are being developed now, there's a lot of intelligence that you can integrate into your product that's available through an API interface from a firm that might have been doing it for a very long time and knows exactly how the
maybe
optimization should be done.
years.
Yep. Oh, I was just going to kind of build on what Sharon was saying, and with regards to the evolution and how they came about being low-cost solutions, really predicated on asset allocation. But now a lot of firms are utilizing them to reach younger demographics like millennials, as really looking for that easy button because it is automated from start to finish. Everything's digital, and that's just what the younger generations seem to be looking for, is that simple solution.
Great. So, next easy question. Generational approaches to wealth management. How do millennials versus boomers think about wealth management? Who is adopting robos?
Well, as I just mentioned, millennials seem to be the primary adapters because of that simple solution, that online experience. But I think that investment management firms are also utilizing this to leverage efficiencies because they can essentially be the architect from the back end, creating their own models and strategies, not only just using ETFs, but can also implement some robos using mutual funds now too. So depending on the type of account, try to maximize efficiencies in certain markets and asset classes, for instance, perhaps looking to leverage some actively managed solutions in those inefficient markets like emerging markets or perhaps even U.S. small caps. So I think it's really expanding the gamut, but I think the hardest demographic potentially to reach is those baby boomers who may not be as technologically advanced or willing to adopt technology. And that creates even another, I think, interesting, or I should say complication or challenge from an asset manager's perspective is the variance or the difference in demographics and their preference for risk and loss aversion, and from a asset asset allocation or portfolio construction standpoint, where currently millennials tend to be more risk averse than many other of the demographics, where baby boomers, on the other hand, may be more inclined to take some risk, but are also looking for more income type producing portfolio solutions if they are willing to use a robo. So it really is, from asset manager, finding that balance.
Yeah. I think the really interesting thing about robos today, definitely, millennials is certainly one of the target audiences. If you think about the amount of assets in robos versus traditional advisors, I mean, we're talking something like 250 billion versus 85 trillion. Clearly, it's still a small drop in the bucket, but it is the millennials that are driving that growth. And I think, in particular, to me, what's really exciting about it is also the rise of micro-investing apps like Acorns or like Stash, right, that are allowing people to invest really pennies or cents and get a start in investing, and that totally democratizes it. I think as we see, then everybody talks about the generational wealth transfer, we will see it going from the boomers to millennials, and nobody wants to talk to a person.
No. Yeah, and I'm glad you mentioned asset classes as well, because we did a survey of investing behavior, and we found that, for example, people in their 30s, the majority of them have had some experience with a peer-to-peer lending site, either as a lender or a borrower. And that goes down to essentially nobody in their 40s or 50s. And so just in terms of what financial options people expect to find in the environment where they're going to be doing investing, there's a change that's sweeping ahead.
So I think there are at least two different constituencies out there. You have the startup robos like Betterment, Wealthfront, Personal Capital, the three that we sort of follow pretty seriously. And then you have the established firms, the Schwabs, the Vanguards, and so on. Do you see any difference in those constituencies that you think, again, the audience should be aware of?
Well, my firm actually, we custody with Charles Schwab, and we've actually are resistant to adopt their robo solution. We can leverage it for free at no cost and basically charge whatever advisory fee we want to attract revenue, which is attractive, but from a pure asset allocation perspective, we're mandated to hold at least 5% in cash. And if that's from an asset manager's perspective, you think about the drag that could have on a portfolio. Gets really where a Schwab, because they are also a bank, makes their money. But an individual investor, because I actually, in wanting to experiment with Schwab myself, opened a robo account there. And even in the most aggressive allocation, I'm forced to hold 9% cash as just a retail investor off the street. So I think that is a huge impediment to overall end results that Schwab may face, versus more of a betterment where now they're also where that isn't necessarily the case, and you also can now have options to get some more human interaction to attack some of the behavioral challenges associated with robos.
I agree with what you're saying. I think that we're really seeing a convergence between sort of the incumbents, the Schwabs and the Vanguards, all the IRAs who are now using technology platforms to have a more automated solution, and the startup robo-advisors. And I think in another, let's say, 5 years, 10 years, we won't even talk about them as being different. And I think that for the majority of cases, probably a technology solution is fine, maybe for 95% of the population. Then when you get to the edge cases, right, that's maybe when you need a little more human advice or advisor interaction, and everybody's starting to offer that.
Mm-hmm. Yeah, I think the barriers to entry are still fairly low, and so the pace of innovation is pretty high.
One of the constituencies that I don't see being fulfilled, if you like, out there, are fixed income robos. We have effectively largely equity allocations, some small fixed income, some cash, except for Schwab, of course, who has a slightly larger. How much cash do you have in your portfolio, as a matter of interest?
Well, when we're managing portfolios, we typically, especially post-financial crisis, have less than 1% cash, because it can be a drag. There's much more, many more asset classes out there that offer better risk-adjusted opportunities than cash. As we've seen interest rates tick up, I will say, cash is starting to be seen as more of a asset class again, like it was pre-financial crisis. I don't think we're going to get to the tune of money funds charging 4.5% or paying 4.5% again, but still 2% is attractive over a savings account that's paying 20 basis points. But typically we hold maybe 1%, and that's mostly to take our fees. So.
Good answer. You can go on now to take a second question, which is,
or maybe someone will jump in.
What about fixed income robos?
Yeah, well, I honestly think that fixed income robos aren't as prevalent as equity, given the largest demographic using them, and that they are younger, and typically we associate younger investors with the higher ability to take risk. I think often neglecting the willingness to take risk, but associate the ability and having a higher equity allocation. But also, if we look at the number of, because they were predominantly passive, a lot of investors and architects of portfolios find that fixed income investments. There you can find much better risk-adjusted measures, find much superior opportunities in active fixed income, and I think it's just recently we've been able to see active managers utilized in a robo platform. So I would expect as adoption picks up, we see more fixed income.
Yeah, and there's a real behavioral issue there, behavioral in the sense of behavioral finance, which is how do you convince someone who's risk averse that the risk averse things to do is to invest in fixed income rather than to pretend that there is no problem and do nothing.
Right.
That's a huge hurdle.
Right. I think when you think about asset allocation, right, all the betterments and the wealth funds, they'll give you, a small slice of fixed income if you want it. But I think what's really interesting that's happening in wealth management is also the use of AI to really develop new products. So for instance, and some of them even predate AI, but risk-adjusted, risk control products, right, volatility-adjusted products, that's all predicated on the availability of other types of data. And I think those new products that are out there give people even more options. And now, again, because of technology and low cost, they're not just available to institutional investors, but they're available, in ETF format for anybody to really go and buy.
Okay, we've gone through a lot of the easy ones. Some
Bonus round.
you can't leave. Question, how is the wealth manager in 2019 better than the wealth manager in, say, 1999? If they are better.
All right. Well, I mean, it's hard when you look back. I think actually the advancement in technology has made it harder for managers to produce alpha. The access to information, as we saw with the gentleman speaking from Prudential, it's instantaneous. And technology is being able to leverage that to find these nuances, I think gives some advantage, but for the masses, active managers are reluctant to adopt technology. It's more the quant that I think, per Prudential's speech, that are more, I think it's a better fit. I feel that most wealth managers or asset managers are becoming pure asset allocators. And how do you really compete with low cost solutions? So it's hard. I think in some places we're better, but some places we're also deficient.
Yeah, and managers have a much more sophisticated clientele now, in the sense that in 1999 there was no concept of, or not enough concept of being in a bubble, whereas now it's everyone is all too aware that the next bubble could be inflating as we sit here, and so the effort has to become more educating people to take a rational approach to risk. As opposed to just indulging their loss aversion.
No?
No,
All right.
I'll go for the next hard question.
Okay.
That's why I'm holding off.
The next hard question is right now. So how are robos progressing with the growth of AI? That's our, not only do we talk about robos here, but we talk about AI. And the sense is that they perform well in an up market, but what about in a down market?
So I think that AI has certainly helped robos. Again, we have seen instances where there have been, glitches with some of the robos, but I think that people learn, or the robos too also learn from mistakes. So I think we're seeing improvement there. But I really feel that even the application of AI to robos or other financial products has just blossomed really in the last couple of years. Again, everybody said it started with asset allocation, but in fact, now we have robo firms that can select individual stocks looking at fundamentals and adjust, on a daily basis or whatnot. So the technology has allowed us to do.
You mean doing what advisors do as part of their normal daily work?
Doing what an active manager might do, yes, as part of their normal work. Exactly.
And also, the investment technology is not just understanding the market better, it's also understanding the client better. So there are a number of firms that have behavioral finance products that others understand or measure other dimensions of personality besides tolerance for risk. So they measure loss aversion, confidence, decision style, and although this technology is still in its infancy, you can imagine crafting a portfolio that meets a client's needs along all those dimensions instead of just putting them on a line from most conservative to most aggressive.
And I think the utilization of artificial intelligence also helps remove some of the natural human bias that even individual managers have, because we all have them. But so I think the technology allows those biases to be removed. It's not necessarily about being the smartest person. It's about trying to make as minimal amount of mistakes as possible and trying to control behavior. And I think AI lends hand in that.
And I'd like to make one other thought. Again, we talked a bit about products. At S&P, we had acquired Kensho about 18 months ago. And so we're using that artificial intelligence, right, and machine learning to generate, again, new types of products. So we can look at, the spectrum of different types of companies and create new categories and new classifications. So we have new economies indices, right? Things about drones, things about space. And I think that also just gives more people more alternative ways to invest.
Yep, I think that's correct. So that was the up market. What about when the market is down, and the concept of trying to have advisors coaching their investors not to panic is crucial. Can that functionality be built into robos?
Well, I'm going to jump in on this one because I have a strong opinion that this is where human beings really shine, because you're coaching someone to behave in a certain way, and having somebody talk you through a crisis is much more valuable than getting a text that says don't panic. But that said, there are only so many phone calls you can make in a day. And so one of the technologies that we're seeing is the ability to sort clients by who's most steadfast versus who's most likely to panic, and call the unstable ones, if I may, first. That can be done quantitatively.
Yeah. Even worse is the email which says you shouldn't have panicked.
Right. But I think we're starting to see an evolution of both a Robo 2.0 as well as an Advisor 2.0. I think from an advisor perspective, the advancement in the tech stack has allowed for scalability to adopt more robotic functions, where even on the Robo platform, incorporating more artificial intelligence has allowed for more human aspects to be incorporated into it. So, I guess that's one of the questions I struggle with is robos become more human or humans become more robotic?
And I think one thing we shouldn't forget, and you touched on this earlier, was a lot of people are looking for a very simple solution, right? And if people are looking for a solution, hopefully, right, behaviorally, you're nudging them in the right direction, buy and hold for the long time, but hopefully they're sort of forgetting it's out there, and they're just continuing to save and not thinking, oh no, the market's in a head spin, let me sell.
Right, and you brought up something really important here, which is people want simplicity. They want their problems solved. And at a conference about machine learning, one of the ironic things is that clients don't want to learn. They don't want an educational experience. They want their problem solved. But they can have a much better investment experience if you can get certain concepts across of diversification and starting early and so on. And so, is there some way to use technology to painlessly feed people the information that they need? I think that's a real challenge.
Yep. I think definitely the human involvement on the downside. I think more so in a declining market is how robos or algorithmic trading performs. Many will argue that they could exacerbate a downturn. I think we saw it back in February of 2018 when the S&P plummeted 1,700 points in a day, and 4 robos had to halt trading. What does this do for a sustained bear market with given the corridors in place that the robo architects are placing and so forth. So I think a great deal of understanding around the mechanisms that the architects of the robo platform is going to be critical, especially as we perhaps enter the late innings of this economic expansion and could see some increased volatility and downward pressure.
Right, and that's a real conflict of interest if the robots are telling the humans not to sell at the same time that they're selling.
Yeah,
that's I have to think that one through.
Next question, two-part. What does portfolio management technology enable? And over the next 5-10 years, what new things will be enabled by portfolio technology in its broadest form?
Well, really, when I think of portfolio management technology, it can span from creating asset allocation, so running mean portfolio optimizations to create efficient frontier and put a portfolio, create the perfect asset allocation for a portfolio to fall in that efficient frontier, to doing research, to trading, and the checks and balances and the portfolio management software. So that's before this was all manual, using spreadsheets to do a linear regression model, to actually manually going through and physically looking at trades to see portfolio drift, to make sure that that every portfolio has the right securities. It was all manual, but now it's all automated. I think that as we look forward, that's just going to increase. I as a chief investment officer, I actually ponder quite often if in 10 years I'll be obsolete. And really no longer be needed except for to be that architect of the software.
If we focus just on the specific, let's say, stock selection or asset selection piece, I think what technology has enabled us to do today is really create incredibly bespoke portfolios for individual clients. So it can really be tapered to their individual needs and customized to them. And I think that's only going to grow. So for instance, ESG, right, environmental, social, and governance is very big topic these days, right? And we're seeing, especially with millennials, that's a key focus. The more that we can have indices that relate to that or product sets that relate to that. Somebody says, I don't want guns in my portfolio. That's a push of a button. That's easy to do today, and that's not something we could have done a few years ago.
Yeah, that's an excellent point, and it's also an area where the motivation is very personal. People have reasons that they want specific views reflected in their portfolios, and so customization is really required, and the technology lets that happen.
The audience, you will have noticed that we have a actually on-demand testing algorithm up here. Sharon has brought light to bear on the problem, and Mark, as is so often the case amongst scientists, has thrown us into darkness, partly. So there are two sort of main camps, if you like, of participants that are involved. There is the investor, the client, and then there is the advisor and the advisor's community, if you like. I think if we start with the advisor, with the technology that we have, the advisor can essentially, plug and play, sign up her client in a meeting, much faster to close, much more immediate as far as the relationship with the client. That client qualification is streamlined. But there are lots of things that the modeling doesn't answer. So one of the questions that has always interested me is, do female clients prefer a female or a male advisor? And I say it in terms of that direction as opposed to saying, hey, does a male client prefer a female or a male advisor? Same question, but what does the industry say?
Well, I would say well phrased for 2019. As the woman on this panel, I'll reserve the right to answer first. Thank you. As I said to you guys when we were having our...
Just to interrupt a moment, we have two people here that know that they can answer second.
Oh, good. we'll flip a coin. I think we talked about it when we were doing our prep call. Yes, there are certain robo-advisors, right, LFS, that are focused on female clients and female needs. I personally believe that money doesn't have a gender, and money is money. So would I prefer to talk to a male, a female, or a robo? It doesn't matter to me.
Yeah. And one of the things technology lets people do is to express their preferences. There's a firm, Wealth Ramp, that was founded by Pam Kruger, which is essentially a survey that you can take about your preferences in how you want to receive financial advice. One of them is the gender of the advisor. And then advisors also take a survey, and Wealth Ramp matches people up based on their answers to these questions. So we don't need to answer this for other people. The technology can let people ask for what they want.
Yeah, but I do wish someone knew that for certain, right? Because of the wealth generation, women are expected to inherit about $40 trillion over the next 20 years. So knowing that answer would, I think, be very helpful. But I can tell you, from an industry perspective, women are absent from as a financial advisor role, which is really sad because results in studies have shown that they're a superior financial advisor to man. They're much more focused on the relationship and have that human aspect in general from what research has shown. So I think if there's something as an industry we can do to encourage more women in the industry, that would, I think, behoove the masses.
Ditto to what Chris said.
Sorry, you were going to...
I just said I'm nodding.
Oh, you're nodding.
For people listening at home.
Good. Yeah, if anybody is in the slightest bit interested, I asked my wife that question, and she said she'd rather have a male advisor than a female advisor. So I'm hopeful that as a result of this event, those of you who do surveys will want her address and want to hire her to answer questionnaires. Moving along. Do you believe that advisors fear the automation and robos will end up effectively replacing a large segment of the advisors out there?
Well, I think today, the common advisor today isn't the common advisor 20 years ago. You have very few advisors today that are actually going in and picking stocks, Coke versus Pepsi, going in and buying individual bonds. They're, typically have a solution in-house that they're leveraging, centrally managed portfolios and so forth. And really their goal is to select the right solution for their clients. Or they're leveraging third-party TAMP managers or turnkey asset managers to do the same thing for their clients. So I don't think the advisor is necessarily in the same position. So I think a lot more today is focused on serving your client and business development. And given the advancements in the tech stack in the wealth management business, I think that there's two subset of advisors. I think those that are nearing retirement that do fear that adoption, that are really just, I'd rather find a succession plan and get out. But then those that are really embracing it because they see the opportunities that presents for them to scale their business. I think the key is finding, or I should say leveraging solutions so you have a single sign-on versus 15 different applications that they have to learn to accomplish their goal.
Yeah, and I think most advisors want to sweep up the long tail of their business. They would like to spend time on the profitable clients and have the smaller clients take care of themselves. And so if there's a technological solution that lets them automate that part of the book, I think that would go over very well. And as long as this is something that can be incorporated into their business rather than cannibalizing it.
I mean, we use AI in all parts of our lives, right? All of us, without even thinking about it. You know, we call up Google Maps to get directions. We're picking restaurants using AI, right? That it's so pervasive that I think that, yes, I understand that fear that technology is going to eat away your job, but it's the way of the future. You can't put your head in the sand for sure. You know, you've got to embrace it, and it allows opportunity. I agree with you, Chris.
On that note, that we use AI in every part of our lives. A question on behavioral theory. Just what you want. This has to do with nudging. If millennials are more risk averse, should robos cater to them or change the individual's minds?
Yeah. I mean, this is something that we've really struggled with, because you can measure people's behavioral preferences, and the question you asked, do you cater to them or do you try to change their minds? And I think most people would agree, you want people there's a set of rational beliefs about how to invest that are pretty much true for everybody. If someone's behavioral outlook is too far away from that, you probably want to scoot them towards the median. But you can't impose that on people, and so what we've thought of doing with behavioral data is to, in the short term, understand what people want and talk to them on that basis. But in the long term, try to educate them more about what outcomes they'll get, if they diversify, take appropriate levels of risk, and so on. So it's not either or, it's short term versus long term, I would say. But I don't think it's an answered question at all. I think it's a fundamental.
And in spite of the fact that there are a couple of people that have won Nobel Prizes that answered the question.
Yeah. Millennials could be right. The new normal could be nothing like the 20th century.
I think it's interesting, just as a matter of fact, that we've seen many retirement plans, 401k plans, default people into target date funds, which is going along those behavioral trends, right? It's saying, you don't know what you're doing,
right.
Let me do it for you. The other aspect of that is just the fact that people are saving, regardless of their risk level, is probably a good thing. So the fact that they've shown up at the table is
right. That's like the zeroth law of investing. Do it.
Exactly.
Yeah. I think it's hard to put people in a box, right, and force people to change just their inherent behavior and who they are at their core. But I think through education, it helps ease the process. And managing assets both on the retail investor as well as on the qualified side, that's been a concern of mine, right? Because it's that default into target date funds, and because millennials tend to be more risk averse, and we're defaulting them into a target date fund that is 90 to 100% equity based. Perhaps they're exposed to more risk than they're comfortable. So providing solutions that are not only target date, but also risk-based, I think is an appropriate solution for companies and plan sponsors to implement for their participants and employees.
Okay, getting towards some of these harder questions. Where will wealth management and the robo industry be in 5 years? We've heard the comment that perhaps there'll be more ESG investing. There won't be any more fixed income investing. I don't know what you're going to say for emerging markets or small caps or.
Well, I would personally like to see robos understand taxes better. It's the biggest source of loss, the biggest cost for individual investors. No robo currently handles that well. And I think it's also somewhere where machine learning is in real trouble, because there isn't a sort of corpus of data you could train tax advice on. So I think something like an expert system, although that's an ancient term. I think they're knowledge systems now or something like that. But something that can codify the ideas of how you build a tax-efficient portfolio and make tax-efficient trades. I'd like to see something like that available to everybody. But it's a big step from where we are now.
Is that because you pay a lot of taxes?
Well, I think we're all interested in that question.
I mean, there are some of the robos, right, like Betterment and Wealthfront, who do offer tax loss harvesting, right? I'm not sure. I've done no studies on how effective it is or how well it performs.
Yeah,
so
exactly.
It's there, but I don't know.
No, you're absolutely right. But they have to write a white paper about like how many basis points this is going to add, and there's nothing that prevents you from like doing a wash sale or making a real tax disaster in your portfolio. So, yeah, there's a lot that could be picked up there.
I think that if advisors are smart, they'll merge, right? To leverage the best of Robo and maximize its scale and the efficiencies that it offers the advisor. It's sometimes odd to say this as a CFA but investments are a commoditized asset. They really are. And so I think it's about leveraging the technology to deliver a good sequence of returns for investors and convincing advisors to adopt that to maximize efficiencies and become more scalable and then focus more on the larger clients that need the customization.
Any other comments? Okay. Let's have a look here. What haven't I selected but noted as a this one is no, it's too much like the nudge. This is like the nudge, but asks in a slightly different way. If one client is more risk averse than another, should the robo customize its recommendation based off the client's personality? So the key word there is personality.
Personality.
I don't know.
I mean, if you think about a lot of the ways that the robos are set up today, and in fact, traditional advisors, right? There's a questionnaire that's asking you, right, different questions. How much risk do you take? What about this? What are your... So all that, I mean, I would call that personality, perhaps. They're trying to divine what that is. I would say maybe, again, if we think about the use of AI, if all these data sets are aggregated and we have a sense of the different types of clients that there are and their risk aversion, we could map individual portfolios to them. I think technology allows that.
Yeah, and that's a very good point. And there's a way that gets used that currently that involves a conversation where you gather somebody's risk tolerance and then you say do a Monte Carlo with the very conservative portfolio that they want, and you say, your retirement will look like this, and they're dismayed, and so then the education begins. And I don't, excuse me, I don't know a robo that closes that loop very well. If there were some way to let people experiment and on their own come to the conclusion that they want to be more aggressive, that might be more convincing than someone trying to sell it to them. I don't know if you think that's even possible.
I think that one of the things we've also seen is the evolution and proliferation, really, of financial planning software. So I think for a lot of people, the ability to plug in what they have and what they expect to have is right there. So whether it's built into the robo or it's something they're seeing on the side, I think that could change their their appetite, right, for risk, because in the end of the day, that's what many people are looking for.
Right.
Am I going to have enough to retire?
And I think one of the hardest things about risk, especially when looking at the risk tolerance questionnaires that financial advisors use today, that the robos are leveraging, is that they mostly focus on ability. And then risk really has two aspects, sensibility and willingness. And I think that gets to the more personality portion of the question, is that willingness to take risk. Not necessarily just are you comfortable losing 10%, but that really the willingness to put everything on black, right? And so I don't think that the current robo has addressed that yet, but I think it definitely has the ability to. But I agree with Sharon that the advancements in financial planning software has really helped modernize the industry, and again add scale to advisors, and not to mention be much more impactful and meaningful for clients. You look back even 10 years ago, and doing a financial plan was extremely static, and it would take 1 to 3 months to complete a financial plan, and heaven forbid that a client asked about, well, what if I do this? Well, then you have to gather all new data and update it, and by the time they're ready to make a decision, the opportunity may be gone. But now with the ability and the advancements in financial planning, that's instantaneous. It's a push of a button. You no longer even have to meet with your advisor. That you can be in a different country and share screens, and they're living, breathing, dynamic financial plans, I think, are much more relevant today to the end user.
Yeah, and that's a really good point, that the questions on a risk tolerance survey confound things that don't belong together. Like if you ask someone, are you comfortable investing in the stock market? And they say no, you don't know whether they're averse to risk or whether they think the stock market is very, very risky. And so in one case, there's nothing you could do, but in the other case, you could say, well, our forecasts for volatility are actually not that bad. So, put your toe in there. And if you measure these things separately, then you really know who you're talking to.
As a last comment on risk tolerance questionnaires, beware of them. They are, by and large, not tested. So with that warning, let's go to open up the questions. Yes.
So actually following up on that same question, I know one of the core challenges with those questionnaires is how do you want to invest? Maybe what they say on the questionnaire and how they think they want to invest may be very different than how they actually need to invest based on their actual emotional reaction to things as well as what they're actually looking to do, and it may just come from they don't understand all of the options out there. So how can AI be used to sort of bridge that gap between I said I want A, but after a few months of working with you, clearly you're doing B, but you still said A, and every time we have a meeting you talk about A. How can it be used to bridge that gap, and is there a company doing that fairly well right now?
Did everybody hear that? Good. Could you repeat the question, whoever wants to answer it first?
Oh, I'm not totally sure I understand the question. You're interested in a gap between what people are asking for and what they're getting. Is it because the advisor isn't implementing what the client has asked for, or because when the client sees the result of what they asked for, they don't like the outcome?
I think it's more about the clients, what they actually want versus what they're telling you they want. There may be a gap there, either because they don't understand all of the financial tools that are available to them,
Right.
or because, if you sort of what was already mentioned of that risk questionnaire may not actually get the emotional response. So yeah, I'm fine losing 10%, but then when I actually lose 10%, I'm panicking for
Right.
more than I thought I would when I was in a nice, comfortable air-conditioned room filling
Yeah,
out the
yeah.
questionnaire.
No, that's a really good point. And what you're talking about is the difference between risk tolerance and loss aversion. And when you measure those things separately, you find out they're hardly correlated at all. So people who are more risk tolerant tend to be less loss averse, but it's a pretty weak correlation. And so exactly what you're talking about happens. You have the people who are courageous on a sunny day, and then they want out. And I don't know a technological solution to that sort of emotional problem other than those are the people who really need to be coached when things go badly. So those are the people you identify as, you call this person the minute the market dips.
Yeah, and I think it's breaking down wants versus needs. And really demonstrating that to the individual that this is what you need, but this is what you want, and showing them, again, you can leverage the financial planning software with goals-based investing and goals-based planning to demonstrate, okay, well, here's all your wants, your probability based off of asset allocation, your behavior, your spending patterns. You're going to get your needs, but you're only going to get about maybe 25% of your wants. What can we do to adjust that to get a higher probability? I think that can definitely help.
Yes.
Hi. Can you share your thoughts about technology considerations and build versus buy? So should firms build their own robos and have their own data science teams? Should they outsource it to someone, buy it from someone? And what are the sort of pros and cons in each one?
I'm clearly on the buy camp. I think definitely with the advances of technology, with the advances of being able to host stuff in the cloud on AWS or Azure, what's out there and what's open source is so available that I would never recommend building your own. I would keep the core layer for certainly buy it, and if there's something you want to tweak, maybe. But generally, I would start with a buy solution.
Yeah, I would definitely agree. We're actually, as a firm, exploring that now. And just when you start layering on the different components needed, both from a human capital as well as from a technology capital, it begins to add up. And then you also have the risk of that human capital being able to keep up with the changes in the industry versus being able to leverage SaaS or software as a service, and that's all they focus on, and they're hiring those people that are keeping up in the industry and making sure that you're really optimizing your use of technology, and usually a lot more cost effective.
Buy.
Hi, Solomon Shields at NASDAQ. Could you give us your insights, opinions into the use of non-standard information now that we have Robo-Advisors and AI? So, for example, on one end of the spectrum, it's like clickstream data, like, oh, these users are saving certain things, bookmarking things, filtering in this certain pattern, whatever, and we can say, well, if you looked at this, you should probably look at this, those type of things, all the way to alternative data usage. So we're going to, upload some footfall traffic information, and it's like these are some retail investment, facilities that you could go look into, things like that.
Well, I hope the investment advisor is outsourcing, the satellite tracking of cars in parking lots to actual investor manager. The other data, I think we're very far from having that kind of instrumentation. I think we're still trying to make intelligent surveys so people can express their preferences directly. And I think in the case of a fiduciary responsibility, you want to be able to say, you expressed your preferences and I carried them out. You don't want to say, I stalked you on Facebook and I think this is what you want, because that does not pan out well.
Yeah, there are a lot of firms that do that. I encourage you not to search Robo-Advisor on Google from your phone, because you will get about 10 different companies pop up on your Facebook stream. And as well as I do, you just kind of swipe to the left or whatever, ignore it. So I would, but I will say that a lot of firms are trying to leverage technology to maximize lead generation, and how best to do that, and getting content out there to garner attention from investors that are digital and online, and build that presence. But I think that's really where it comes down to, is lead generation.
Yeah. I think from my perspective, from S&P Global perspective, I think that alternative data is really, like NASDAQ, one of the exciting areas, and people are looking out to build marketplaces that other people can then take and use as tools to create different types of investments. Again, classification, categorization, using your shopping mall data, using other satellite data, using unstructured text, right? Sentiment data, geopolitical data. I mean, there's all sorts of new products that can be created. And I think initially, you see them with the hedge fund industry, and then it kind of trickles down into the mass market. And for sure, as an index provider, we will see those products reach the retail consumer.
Right back here.
We have a little over 5 minutes, so one more question.
Yeah.
Oh,
Well,
already in
this
the
is
back.
This is Suraj Gaikwad from Gods in AI. My question to you is, what do you think how AI could have prevented 2008 financial crisis by deploying the present AI solution, according to you? Because during that period of time, very few Wall Street people acted like an AI and gained profit from that huge fall. But if we could have deployed AI during that time, I think we could have prevented that. But what's your view? What's your opinion on that?
Actually, I was just having a conversation about this yesterday in the office. And we were talking about the ability to sort of in a real-time basis match credit ratings, let's say, to some underlying mortgages, right, within an entire tranche, right? And that if you could do that on a real-time basis, you could swap in and out of riskier, less risky assets along the way. So that's certainly one thing that could have helped.
I definitely think from a predictive standpoint it would have helped, but at the end of the day, I doubt it would have completely avoided it because of the problem that was created, that bubble that was created. I think that the financial crisis was essentially unavoidable. But I do think that could have had a little bit more predictability, I should say.
Yeah, I don't think it was a failure of prediction. I think it was a failure of capital to bet appropriately. The gravy train was just running too strong.
Because when you have individual investors using their homes as ATMs, and banks freely giving them that money, there's not much AI can really do to stop that.
Okay, 3 minutes and 45 seconds. Anybody want to ask a long question, which would mean that the panelists would not be able to answer? Yes, one long question coming up.
Not to put you on the spot, but any examples of robo decisions being kind of like disastrous, or any bad stories of robo decisions that you can share? Without naming names.
Yeah, well, and I think it kind of goes to the early evolution. I think the early adopters, in theory, it's a great mousetrap, right? But I don't think it goes back to understanding the mechanism and understanding from a portfolio construction standpoint the corridors that the architects of the robos are putting in place. Because again, you look back to that February of 2018 where it dropped 1,700. A lot of those in the robos halted trading is because their corridors were too tight and didn't necessarily understand the inherent risk that all these algorithms are putting in the market that caused even more of a sell-off than was expected. And so it's going back and understanding, I think, the risks and widening the perhaps potential standard deviation or the variance that we could expect to see.
Okay, I think we're coming to, you get to speak consecutively.
I'll try to keep this one really short. I was wondering if any of you had a comment about the quality of the models that are being used in these robo-advisors. And in the end, the ability to predict the future of the stock market, the bond market, is not improved a huge amount. It is, 75 years into asset allocation.
Right.
Are any of the robo-advisors actually doing anything different, or are they just doing it faster?
Well, I think that's a great question because you look at the average robo-advisor that has a 60-40 blend, and returns on an annual basis could be 400 basis points apart. So from base risk perspective, you would think they'd be very similar. The returns would be much more, the delta would be much smaller, but in reality it's not. So I think that it's having the kind of the architect of the Robo platform that really focuses on the sequencing of returns and the portfolio optimization aspect of it. But the returns do vary greatly, so it's important to understand that when selecting a Robo.
Yeah, and one of the great things about solving individual investment problems is that it's so much more interesting than sort of institutional investing, because people have a finite horizon and their lives go through stages. And so if you look at the sort of Monte Carlo that happens in virtually every robo-advisor, it makes very simple assumptions about how people are going to accumulate and spend down wealth, and it doesn't let you make any adjustments once you've started on that trajectory. So I think there's a huge opportunity to give people a more realistic view of the sort of portfolio of things that might happen to them in the future.
15 seconds. Thank you very much, everybody. Thank you. If my boss, Michael, is here, just want to let him know that we'll be more than willing to come back next year with a solution to some of these problems which have not been solved to date. Thank you.
Thank you so much to our wonderful panelists. Let's give them another round of applause.